Hey there, this is Pat Ennis of Ennis Legacy Partners. Welcome to the Exit Readiness Podcast. I'm here with co-host Walter Dial, CPA and tax partner, GRF CPAs and Advisors in Bethesda, Maryland. Our mission here on the podcast is to provide you, the business owner, with subject matter expertise on topics pertaining to building transferable or sellable business value, and then for planning your eventual exit from the business. We want to help you build a business that's transferable and then help you exit successfully on your own terms and conditions with the content that we provide here. You might be listening today and planning to sell your business at some point in the future to a third-party buyer. We have clients who want to transfer, sell their business to kids, to insiders, management team, maybe do an ESOP. But then a good number of them want to sell to a third. Selling to a third party is going to make the most sense. Or you may be an owner who's planning to grow your business through acquiring other businesses, which of course is a viable growth strategy. So either way, it's going to serve you to understand a buyer's point of view. And that's our topic today. Understanding a buyer's point of view. And our guest is David Barnett. David has over 20 years of experience working with small business owners, helping them with business growth as well as transactions to buy and sell businesses. He's the author of 8 books about small business transactions and local investing. He also hosts a popular YouTube channel with videos about buying, selling, financing, and managing small businesses. And he can be found anytime at his blog site, davidcbarnett.com. David, welcome to the podcast. Great to see you.
Hey, thanks, Pat. Thanks, Walter, for having me over. Always happy to come and be a part of a conversation.
Excellent.
Hey, David. Thanks for joining us. Looking forward to the podcast today. I'm sure it's going to be great. Let me just start off by asking you a question. So, I don't know if this is true or misperception, so I'm just going to ask you. Someone's out looking to buy a business. Is there the first thing that's going to be, the thing that's of utmost important to them is the financials of the business, the cash flow they can generate? Is that generally true or not necessarily?
Well, typically when someone's looking to buy a business, they're looking to acquire a cash flow and they've got some kind of motivating factor behind them. And so, if you go online and you say, how do I sell a business or who's going to buy my business? What is kind of funny is you're going to run into all kinds of articles about ESOPs and private equity and all this other kind of fancy stuff. But the reality is that the most common business acquirer is a person who doesn't like their job and they want to buy a business to run their own company, but they don't want the risk of doing a startup. And so it's that person is looking for an income for themselves and their family. And that, if there's no income there, if there's no cash flow, there's going to be very little interest. I always say that there's 2 big questions that a buyer is going to want to know. What is the cash flow that this business puts off that I would be able to acquire? And number 2, will that cash flow continue under my stewardship? And so the first question is answered by examining financial statements and the history of the business. And, then you get into things like recasting and normalizing and all that other kind of stuff, add backs and stuff. But the second question is going to be much more related to, where does the goodwill really reside in this business? Is it with the brand or is it with the individual? And are there sort of secret sauce skills that the current owner has that I might not have that is going to cause an impact on the business? Are there strong relationships, with the customers and the seller? That kind of thing. And so, you know, in a nutshell, I think, yeah, that people are looking for a cash flow.
Yeah, and hey, David, follow up to that question or an addendum. We're talking about buyers, but there are different kinds of buyers, right? There's strategic buyers, there's financial buyers, PE firms, and then two, a buyer you just mentioned, another category that we don't talk a whole lot about here, and that is someone who's basically buying a job. Is that how you might say it? Where they tired of what they're doing and they want to and they want control and freedom, so they're going to buy a business and provide income and cash flow for their families that way.
I describe it as someone who's both buying a job and making an investment at the same time. And so, when we look at this cash flow, oftentimes a business will be presented, here's a business with, $500,000 of seller's discretionary earnings is one of the measures of cash flow, for example. Well, when you see that number, what I'm doing when I'm working with one of my buying clients is I'm saying, okay, showing up to work there every day is a $170,000 job. So the value of your time as the manager of this business is 170. That means the investment return is 330, right? And so we have to look at this from two different points of view. The that same business, if it is presented as having a SDE of 500,000, a strategic acquirer who is going to buy that business and put a manager in place, they're going to certainly ask themselves, how much is it going to cost us to have a manager step in here and replace the current owner if we can't, integrate it right into our existing, you know, wheelhouse of operations and everything. So everyone's going to look at it in a slightly different point of view. And for those buyers who are going to become an active entrepreneur and run the business themselves, they're looking at it from both of those points of view at the same time. They're saying, what is the job? Will I enjoy myself doing this? Is it going to be good? And is this endeavor going to be a worthwhile investment? For me and my family, what is the future then going to hold? Because oftentimes these people too will have a plan initially when they get into this of what they perceive their exit might be. So they might think, hey, I'm going to run it for 15 years, then I'm likely going to sell it. Or maybe I'm going to, turn it into a real family business, bring my children into it, and they're going to succeed me as the operator.
I mean, the type of buyer you're talking about, I mean, one of the questions they're going to ask themselves is what's the advantage of buying this business versus just starting my own? And so, a business has to have, to make it attractive in that situation, they've got to have something going for them, whether it be, if it's a retail store, maybe a great location with a long term transferable lease. Um, Maybe they've got an incredible staff in place, or they've got a well diversified client base, something like that. What do you look for as the main features in a business that would entice someone to buy rather than start their own?
The deal has to make sense. So, have you ever heard of the term BATNA in negotiation? Best alternative to a negotiated agreement. One of the things that we often examine when we're looking at a business is we say, hey, what exactly are we getting here? And what would it cost to reproduce? Like what if you decided just to try to start a business? There's a couple of recent examples that come quickly to mind. One was a lawn maintenance company that had a mixture of residential and commercial accounts, and the seller wanted a really high price for what he was selling. And at first glance, it kind of looked like it made sense. It was many small businesses sell for a multiple of seller's discretionary earnings between 2 and 3 times, and the asking price was in that ballpark. So on the surface, you say, okay, well that kind of makes sense. But then when you realize the number of accounts that were there and the number of employees that were part of the team, I asked the buyer this question. I said, could you hire a couple of guys to be the lawn maintenance crew and then hire another person to go knock on doors? And, do you think after 2 years of work, you could build the same clientele that this business has today? Now, what would it cost you to do that? And the number was far less than what the asking price was of this business. And that's the kind of comparison or thought that a lot of buyers are going to go through when they're thinking about doing this deal is there something here that I just cannot get my hands on without doing the deal? So, for example, that primo location, we're the only place to buy gas on, when you drive out of Disney World or something like that, right? We have this primo location or something. Um, and so then, if you've got something really great, the next question is, does the price make sense? And this is where a lot of sellers kind of fall down because they will treat selling their business like someone might treat selling a house or a piece of artwork. And when you put a house up for sale, you might ask a high price, thinking to yourself, I'll just reduce the price later if nobody comes and buys it, right? The problem though with a business is that when you put your business out there for sale, when you advertise, the machine shop with $3 million in revenue and a staff of 10 or whatever, there's already somebody out there looking for a business like yours. They're waiting for an opportunity to buy a business like yours. And when they get their alert from BizBuySell or wherever your business happens to go up for sale, saying, here's the machine shop you're waiting for, and that buyer takes a look at the listing and goes, wow, this is way out of whack. This asking price is horrendously high. You may not meet that person because they don't think that you are going to be worth their time to deal with. And so you may actually miss an opportunity to meet what I call the qualified buyer, which is the person that has the background, the experience, the equity built up, the good credit score and access to further debt to buy the business. You're not going to have an opportunity to meet them because they don't think that your expectations have been properly calibrated. Who you will meet are other people that also don't know what they're doing. And so then the two of you can just waste a lot of time. And then you can even get a full price offer from someone like that. And then they'll go to their banker and the banker will explain why the deal doesn't cash flow. And then the whole thing falls apart after 8, 12 months have been wasted. And so this is why getting the right price on it from the beginning is really important, and identifying who that buyer is going to be. So you mentioned, strategic buyers. A strategic buyer is often one that is willing to pay more for a business than what one of these individual buyers, I call them financial buyers because they're looking to acquire that cash flow for themselves. And so you have to know that the business you have is going to actually be suitable and meet the needs of a strategic buyer in order for you to, price it with that extra bit of gravy. And then you need to understand how you're going to go through the process of finding that strategic buyer, because it really is a different kind of sales process. If you've got the small retail store and you can sell it yourself, or you can go to a business broker, for example, they're going to put it up on one of these business for sale websites. They're going to try to attract buyers who are going to come and take a look. That process is very much geared to that financial buyer. If you have something that's going to be of interest to a strategic buyer, it's going to be driven by more of a sales process. It's a different kind of broker that's going to do that for you. And they're going to go study the market and they're going to try to identify specific entities out there who, for whom it's going to make sense to come and buy your business. And so you're talking about a much more complex kind of thing. Those people are going to want to, be compensated for that effort. And so we're usually talking about a bigger entity to begin with, right? When we're talking about a strategic acquisition target.
Yeah, yeah, and so and something you've mentioned a couple of times that we probably need to define. We're more often than not using EBITDA
Mm-hmm.
in our conversations here. SDE, seller discretionary earnings. You want to describe
Yeah, sure.
what is
So
that calculation, and then when that calculation is actually used versus EBITDA.
sure. So seller's discretionary earnings is the amount of money available to an owner operator that works full time in the business, and it's very closely related to EBITDA. So basically, you look at the net income of a company, and then you add back your EBITDA add back, so interest, taxes, depreciation, amortization, any other sort of you know non-recurring expenses, one-time things, the normal stuff you would normalize if you're getting back to EBITDA. But then the owner is also going to add back their salary if they paid themselves, for example, a W-2 salary. And the reason for this is that when you own the company, you can really pay yourself whatever you want, right? You own the business; it's up to you to decide. But we add all that money back so we can say to a buyer, if you buy this business, this is the cash flow you will have access to. Now, to fully inform that buyer, we're also telling them, out of this cash flow, you need to pay yourself, pay your taxes, pay for your debt service, pay for capital reinvestment, any new machinery, equipment, et cetera, because we've added back depreciation and amortization. So here are the things you have to account for out of this budget of cash flow that we've calculated. And the relationship between seller's discretionary earnings and EBITDA The difference between them is the fair market value of a manager who runs the business day to day. So this is why I say if you have an SDE of 500 grand and the normal fair market wage of a person to run that business is 170, then your EBITDA would be 330. And so that's how they relate to each other. So when do we use them? Well, typically SDE is used on Main Street. And my definition of Main Street is 500,000 in cash flow and below. And when you kind of cross that 500,000 line, people are more inclined to deal with EBITDA figures for a couple of reasons. And mostly it's because the buyers and sellers are a little bit of a more sophisticated crowd, and they understand the difference between, the market wage someone should be paid for doing that administrative leadership role versus the cash flow that is theirs because they are the investor, the equity owner of the business. And so, from my point of view, when we cross that 500,000 mark, I call that the lower middle market. And it's important when you're listening to conversations like this one. So, I mean, thanks, Pat, for bringing this up. All kinds of people are out there on the internet having conversations about buying and selling businesses, and they're using all kinds of definitions, including the words small business. There's a very famous book, Harvard Business School Guide to Buying a Small Business. And in the introduction, they define a small business as one having a revenue of $10 million. And in my space, I tell you, I don't meet many people that consider their businesses to be small and have a revenue of $10 million, right? And so you always need to understand what the frame of the conversation is. So a lot of the people that I work with, we're in this Main Street space. So we're talking about cash flows under 500,000. And that line, that demarcation point, it really does vary by industry. In some industries, it's kind of more like 750. In other industries, it kind of crawls down to 400-ish. But there's some point there where it is expected that a business is probably going to be run and managed by someone who may not be the owner. And it's when you kind of get into that territory that you're, in my books anyway, in that lower middle market territory.
Mm-hmm. Yeah, well done. That was well described. Great explanation. Um, so, in regard to let's keep strategic buyers in mind. Uh, in regard to the topic of today's discussion, uh, understanding a buyer's point of view. From your experience in being involved with transactions, what are some other things that we haven't hit on yet in regard to understanding that strategic buyer's point of view when they're looking to make an acquisition? Maybe in regard to, we've hit upon, well, we just touched on valuation. Anything else you'd say about valuation or operations, market and competition, whatever it might be, that's gonna help listeners when thinking about a buyer's point of view.
Yeah, I think that obviously when you're building your business, you want to be able to have the easiest business to run and the most profitable business to own, right? And so it's funny because people will often say, what things should I do to prepare my business for sale? I'm like, well, the same things really you should do to keep your business running easily and profitably, right? And the earlier you do these things, the more you're going to enjoy that cash flow before you sell. So you're overall going to end up wealthier as an owner. But there's different kinds of strategic buyers, and this is where identifying who likely the buyer could be is going to be important. So you can have these highly bureaucratic, really big entities, right? So if you were going to sell your privately controlled business, which was a mid-sized business, and you were going to sell it to a publicly traded entity, in all likelihood, when they did the acquisition, they would completely integrate and kind of steamroll all of your systems and integrate it into what they already do, right? And it was just kind of like, what is it, consumed by the Borg sort of thing, if anyone's a Star Trek fan. But there's also strategic acquirers who may not be those big, giant bureaucratic entities. They may be smaller, more nimble. They might be just a little bit bigger than you. And when they come and take a look at your business, they may actually be looking at some real challenges with respect to integration. They could also be looking at your processes and systems and saying, maybe we should be applying this particular thing across the rest of our own company once we do this acquisition. And you can actually hear stories of this, of entrepreneurs explaining how they'll do several acquisitions and start to collect best practices from all of the different entities that they're acquiring that they then bring back and improve the rest of their organization with. And so the strategic acquirer, when they look at the business, they're going to be thinking to themselves, what is this worth to us? So if we buy this business and maybe we have some other products that we could start to sell through this channel, we're going to make money in that way. Maybe we can see some great new techniques or something that this business has we can apply through the rest of our organization to increase our efficiencies. That obviously is going to be of benefit to us. They're going to look at all the reasons why they might want to do the deal, but that doesn't necessarily mean they're going to pay you for that incredible delta in their own performance, because they fully understand all the work that's going to have to be done after the deal to realize those improvements. And so that's why I say this kind of buyer is going to be willing to probably pay more than that financial buyer, because that financial buyer has got to make the numbers work based on the cash flow you have. And you start to hit an absolute ceiling where it's just not possible for them to pay any more money unless they're willing to, go without a paycheck or something crazy like that. And the problem with this small business market is the lack of transparency in data, the fact that all the transactions are private. And you do get these crazy scenarios where someone sells their house in California and, then they go and buy another business all cash for a crazy high multiple. And then that guy goes and, the seller tells the story at the golf course and everyone now thinks that they can get this really high price. And it's really just because the buyer was not informed. It was a rare circumstance of luck. But the seller doesn't get that. They think that they're an excellent exiter of their business because they happen to luck out in this way. The problem with those abnormal situations is they then color the expectations of other entrepreneurs who think that they should be able to do the same thing. And so you know yes, the strategic acquirer is going to be willing to pay more than the financial buyer, but they're not going to give you all the gravy of their potential, growth or excess in cash flow that they're going to realize, because the only reason they're doing the deal is because they want to earn more money. They want to increase their cash flow. They want to do better for their shareholders. And there's got to be some meat on the bone for them. And this is one of the things I think sellers really need to realize, is that you cannot price the deal for perfection and leave nothing left for the next person, uh, because the next person is going to look at that and go, wow, now I'm in a scenario where absolutely everything has to turn out just perfectly in order for us to just get something that is worth what we paid, let alone increase our returns and our bottom line for our shareholders. And a prudent manager just isn't going to do that kind of deal. There's got to be something in it for them.
Yeah, I think that's a really good point. I mean, we've talked on this show before about earnouts. I mean, do you see those as something that is like a necessary evil? Do you look at them as a positive, or do you try to stay away from them?
So earnouts and seller financing, I think, are absolutely necessary for sellers to get a quote unquote fair price. Simply because the seller is in a position of complete knowledge and the buyers often are not. Regardless of how much due diligence you do, a buyer is not going to know everything about a business that a seller does. Now, an industry buyer in a strategic acquisition, they're going to have certainly a far better understanding of what it is they're buying if they already own other businesses that are just like it. And the first thing they're going to do is compare the financial statements of your business with some of their own operations that are of similar size. They're going to say, how do we benchmark? Like what does this look like? For that financial buyer, the individual, they could be changing industries, right? They could really be at a disadvantage. And one of the ways that sellers offset the lack of knowledge is through creating deal structures that help them offset risk. So most seller notes are going to be subject to offset in the case of material misrepresentation or undisclosed problems, liabilities, etc. There's going to be warranties, based on what information was disclosed. And if you're selling a business, something as complex as a business and fragile, I always point out that you can't ever show me a picture of a business. If you show me a yard full of trucks or a factory where things are being done, I'll say, well, that's a picture of a yard full of trucks, and this is a picture of a building with some machines. But what a business is a business is a system where humans, capital operate together in a place to produce a cash flow. So it's a symphony of action and organization. And as such, it's very fragile. So if somebody takes it over and they mess up the system somehow, the whole thing can fall apart. Buyers are very aware of how fragile it can be. They know that this is a dangerous sort of thing.
In regard to the seller, okay, what would you say to the seller in light of their behavior in a potential transaction, in light of everything you just said, in regard to the buyers, and again we're really focused here mostly on strategic buyers.
So I remember what I was going to follow up with, and
Okay,
maybe I'll tie it into the new
all
question.
right,
But
okay,
the
okay.
follow on to the seller note thing was the earnout question, part of what Walter had asked me. So where a seller note is a debt instrument, typically is defined in value. Like, this is I owe you $1 million. I'm going to pay you over this period of time. That is for a defined value. The earnout is a shadow form of equity. Because what you're basically saying with an earnout is you're saying, I'm giving you an interest in the successful operation of this business for some kind of period of time based on a bunch of criteria, right? So maybe the earnout is a percentage of growth above or sales above a certain line, or percentage of this, or a function of that. It's usually, you know, that there's some great story that's been told about how wonderful the future is going to be of the business, and the buyer is saying, you know what, I'd like to be a part of that. It hasn't happened yet, or there's been a huge jump in the last year. We don't know if this has legs it's going to carry forward. So I want to be a part of it. I really hope that it's there, but we really can't rely on your story to trust that we are going to pay all this money, because ultimately the business has got to pay for itself. The cash flows have got to be there. So when they ask for an earnout, what they're doing is they're kind of making you their partner in a certain degree, in a limited way, so that they can pay you this money that you want, but only if things work out the way that you've claimed, right? So it's almost like a partnership. Now, when the buyer is trying to figure out how on earth they're going to, get the money together to meet your price expectations, and sellers say, there's no way I'm going to finance part of it. I'm not going to carry a note, or I don't agree to do any kind of earnout. I'm not going to do this. Well, the message it sends is that the story is a fairy tale meant to create an enticing, lure, a siren song, right? You're drawing me into this deal, but then you're not willing to participate in any way in making sure that what you claim is going to happen will actually happen. And so it's a big red flag, right? I and I see this a lot in the Main Street space, where a seller of a business for $500,000 is going to say, I won't do any seller financing, bring me someone who's got cash. And I say to them, like, um, someone with $500,000 in cash isn't trying to buy a $500,000 business. Someone with $500,000 in cash is trying to figure out how to buy the $2 million business. And the same thing applies anywhere. This morning, I was at a networking breakfast and I met a man that I've known for years. He grew up in a family business, and they sold to a publicly traded company. The publicly traded company could have written a check for that family business because of the disparity in size, but they didn't. In fact, not only did they insist upon a seller note in that deal, but they insisted that the seller note be on standby for 5 years. So for 5 years, the family collected interest on the note. And then on month 61, the note started to amortize over a 5 year period. So it took them 10 years to get their money out. And the buyer could have written a check, but the buyer wanted the commitment and the guarantees that came with the seller note and the offset clauses that were part of that. And the oftentimes the buyer, if it's a big company like in this situation, they're very sophisticated. Sort of the levels of sophistication that we see in business are Small business people try to maximize their net income because they think this is the way to earn more money. The really big boys are trying to maximize return on equity, right? And this is why, big companies will use revolving credit to support receivables and inventory, where a small profitable mom and pop business will try to pay off all their debts. They'll finance their own inventory and receivables with their own cash, and they'll destroy the return on equity. But they think they're being smart because they're not paying interest, right? And it's sort of an evolution. And so these big corporate buyers, they look at the deal and they say, how can we make this make the most sense for our shareholders? And that usually brings in leverage. And they're going to look for leverage wherever they can find it. And when you're buying a business, one of the biggest sources of leverage, and the only place you can find it, seller financing, is in the acquisition of a business. And that's what makes it attractive to some of these buyers.
Excellent. Okay. As we wrap up, answer this question. Now that listeners who understand more fully the perspective of the buyer, how should it change their behavior?
Yeah, I think the biggest tool or the biggest lesson out of all of it is empathy. So you just have to play a game. You just have to pretend, what if I was the buyer? How would I look at this? And I find that business people are successful because they think a lot about their customers. And so you think about the customer, you think about what the customer wants, what the customer values. You talk to your customers, you ask them the question, what do you think about this? What can we do differently? How can we be better? And then for some reason, when people get ready to retire, they go and they try to sell their business, but they become entirely self-focused. And they fail to realize that when you're selling a business, the business now is the piece of inventory. If you built a career out of selling machines, the machinery is your inventory. You're selling your machines to your clients. When you want to sell a business, the business itself is your inventory and you're selling it to a buyer.
David, thanks for joining us. Really appreciate it. Is there anything, let me ask you two final questions. Anything you would like to promote today? And please tell our listeners how they can get in contact with you.
Yeah, sure. So davidcbarnett.com is my blog site, and it's kind of like the central place where all my contact information is, and there's postings all the time with my new content. If anyone's interested just in the topic of buying, selling, managing, and financing small and medium-sized businesses, I would invite them just to come and subscribe to my YouTube channel or search David Barnett Small Business on any of the podcast apps. I will be found quite easily, and the podcast is just the audio of my YouTubes as well as other appearances and stuff that I do and things like that. And it's all that stuff is free. I'd love for people to come and sign up. And I know that your audience is primarily business owners, but I guess the big thing I have to promote is this fall I've got a brand new book coming out, Buying versus Starting a Small Business. And I just got the proof copy, and it's going to be coming out on Labor Day. And it's for first-time entrepreneurs, people thinking about getting in business for the first time. And it's going to be out just in time for Christmas. So for those business owners in your audience, if they've got children, relatives, etc., I think it would be an amazing gift.
Fantastic. Thank you. And again, thanks for joining us. It was great.
Awesome. Thanks for having me.
Sure. And listeners, if you want help in maximizing the value of your business or planning for your eventual exit, you can reach Pat at 301-859-0860, and you can reach me at 301-951-9090. If you benefited from today's episode, please consider liking and sharing it on social media. As always, thanks for listening, and until next time on the Exit Readiness Podcast, this is Walter Dial and Pat Ennis signing off.